Hey guys, welcome back to the mind-blowing video series of tips, tricks, and strategies for your income taxes. Again, I am your instructor, Tyrone Gregory, the Peoplepreneur, founder of the actionfromsquareone.com website. And this is video number 3. So, quick recap. So far, we have discussed what is taxes and learned that it's a pay-as-you-go system. We've talked about how to identify the taxable income and then how to determine our tax liability. So now in this video, we're going to tackle the question of, well, how to pay. Now comes the fun part. We've done all this work to get as close as possible to the exact amount that we are responsible for. And now that we know that, how do we pay it? Well, there's only 2 ways for one to pay their taxes. There are other ways, but the other ways are a lot nastier, like garnishments and liens, and I don't want us to pay that way. So let's stick to the main 2. Quarterly estimated payments and withholdings. So let me cover quarterly estimated payments first, right? This method is mostly used by people who are not receiving W-2 wages. So more for people who are retired, very common amongst the self-employed, or for those individuals who are, let's say, investors and do day trading and things of that nature. Those are the ones who use the quarterly estimated payments. And as we can see from the formula here, it's very simple to figure out your quarterly estimated payments. You take your tax liability and you divide it by 4, and that becomes your total payments. There are a few factors, however, that go into when you're going to pay it, like your fiscal year and accounting method, but I'm not going to go down that rabbit hole right now. So I'm going to stick to the more basic one. So let's talk about it, right? So if income is received or earned between January 1st and March 31st, then your payment is going to be due April 15th. If the income is received or earned between April 1st and May 31st, then your payment is going to be due on June 15th. If your income is earned or received between June 1st and August 31st, the payment is going to be due September 15th. And if your income is earned or received between September 1st and December 31st, then the final payment is going to be due January 15th of the following year. And this is the form used to pay, the 1040-ES. Very simple form, very easy to use. You'll notice it's just asks for your name, social security number, addresses, and if you're married, you'll need to do the same with your spouse there. Notice that it provides you with a due date. So again, it makes everything simple for you. But also, more importantly, note there that it tells you who to make your payments out to. Please make sure that anytime you make a payment, whether it be through check, money order, or cashier's check, that you make it out to the United States Treasury. So, and the reason that is because, there's a funny story. I don't want to say it's funny, but it's interesting. There was a tax preparer that I read about who created a company that had the initials IRS. I don't know what the actual name of the company was, but the abbreviated initials of this company that this tax preparer created was IRS. And as a tax preparer, he would make his clients owe money and make the check payable to the IRS, in which he then would take it and deposit it into his bank account. And this guy made millions of dollars until he finally was caught. And of course, he's doing federal prison time. But it was amazing that because it was made out to IRS and not United States Treasury, those people lost a lot of money. And of course, that guy made a lot of money illegally, but that was just funny. So make sure anytime that you make payments out to the federal government, United States Treasury, and make sure you do the same for your state if you have one. And this form you can find easily on the irs.gov website. I'll put a link for you below here in the video description. Real easy to find. And of course, there's a lot of other methods. You don't necessarily have to always mail in. If you wanted to make payments, you can also do it directly on IRS website. You can do debit card, credit card, or things of that nature. But this is probably the most common way people do so. All right, so let's talk about the other method, which is withholdings. The most common method, especially for those who are W-2 employees. And this is where it gets interesting and fun at the same time. And the reason that is because withholdings happen automatically, which means that many taxpayers have no clue as to how it's happening or why the amount is what it is, which is why we either pay too much or too little because we only receive what we receive. And I know I talked about withholdings a little bit in video 1, but let's go into it a little bit more. So the question is, if it happens automatically, how do you control it? Well, we do this through what we call a W-4. Now, the W-4 is what tells your employer exactly how much federal taxes to take out, which is why it's probably one of the most important forms for a W-2 employee, because you want to be able to tell your employer exactly how much to withhold. If you are a W-2 employee, then you have filled out this form. Most of the time, it probably came with your hiring documents, came in your hiring packet or something of that nature. And if you don't remember filling this out, or if you want to get a new one, which I suggest that you do after we go through this video, you can get it from a couple of places. You can download one from the IRS website, or you can just go to your HR or payroll department and ask them for it. Sometimes they have them online where you can fill out. You don't have to download anything. But yeah, so I suggest that you definitely get a hold to one, take a look at it, make sure everything is on point, especially after we go through it. And you'll notice it's real easy to fill out. Not much required information. You'll notice the sections, again, asking for your information. Then it's going to ask for the total number of allowances. Then after that, you simply just sign it. So it's very, again, very simple. But for purposes of what we're trying to do, we are only going to focus on lines 5 and 6. Line 5 is where the difficulty comes in. Most of the time when we're trying to figure out line 5, we have to go to the top of the W-4 where there's this worksheet, which off top seems just a little, it seems pretty straightforward. But by the time you get to line F, most people end up looking like this. Trust me, been there. So here's what I want you to do instead. Forego the worksheet and just place a large number on line 5. Don't be ridiculously large. Just be a moderately large number on line 5. And for those of you who are worried because you've heard the rumors that say, well, if you put more than 10, the IRS is going to come down and request and dig into your business. Don't worry. As we can see here, as of January 1st, 2016, the IRS states that that requirement has been eliminated. Keep in mind, though, that it also states that it still can be reviewed. Now, what triggers a review is if you are owing large amounts of money. So again, following this simple process that I've outlined here, you won't be owing lots of amounts of money. You're going to pay just the right amount, right? So there's going to be no need for the IRS to review your withholding certificate. But as a rule of thumb, I'll say this. If your annual income, note this is your annual income, not your taxable income, your annual income is between $20,000 and $61,000, then I suggest that box 5 should be 15. Okay. If your annual income is between $61,000 and $250,000, then I suggest box 5 should be somewhere between 15 and 62. As you can see, I haven't quite figured out the ratios yet, but hopefully you get the point that the higher your annual income, the higher the number box 5 should be. However, if you're not comfortable with putting large numbers on there, or your payroll department has some qualms about it, just put the highest possible number you feel comfortable with. And the reason I say this is because the goal is to have the payroll department to withhold as little as possible. As a matter of fact, you want them to withhold zero if possible, so you can specify on your own the correct amount to be withheld from each paycheck. So I hear some of you saying, well, why not just go exempt? Don't you do it. Exempt is what get people in trouble. Do not go exempt. By law, the only way you are allowed to claim exempt is if you had zero tax liability last year and you expect to have zero tax liability when you file again. So to see if you meet this qualification, look at your previous tax return. If line 63 is zero, or, if you're using another tax form, the 1040A or the 1040EZ, look for the line that says your total tax. If your total tax is zero and you expect that to be the same exact in the year you file again, only then can you claim exempt. If that doesn't apply to you, then do not do it. So now let's talk about line 6. This is what everything that we've talked about thus far has been leading up to. The line that gives you all the control. If we look at the W-4 again, we look at line 6, it asks us what additional amount do we want to have withheld? And if we've done it right, that means that line 5 has a high enough number as to where our payroll department is withholding nothing on their own, which leaves line 6 for us to dictate exactly how much to withhold. So this is how we're going to figure out line 6. You will need to know these two things. Your pay frequency, meaning are you paid weekly, bi-weekly, semi-monthly, or twice a month, as some people call it, or monthly. And if you're not sure, please check with your HR or payroll department, especially because there is a difference. Bi-weekly is completely different than semi-monthly. And let me give you an example. Here we have the frequency versus the number of payments. If you're paid weekly, that means you're going to receive or get paid 52 times within that year. If you're paid bi-weekly, you're going to get paid 26 times or 27, depending on the actual year that we're in for that year. If you're paid semi-monthly, you're going to get paid 24 times that year. And obviously, if you're monthly, you're going to get paid 12 times that year. And so now you've determined your pay frequency. The next part of the process is get your tax liability. And at this point, you should already have this number. So again, your pay frequency and your tax liability is what we're going to need to know. And this is the point we've been waiting for. Here it is. Drum roll, please. And the crowd goes wild. The formula. In order to arrive at that perfect return, here it is. Tax liability divided by pay frequency equals the closest amount to exact that you are to have withheld from each paycheck. Okay, I got a little excited there. So here it is in plain English. This is the formula. Tax liability divided by pay frequency equals your total withholding per pay period. This is the amount that you're going to place on line 6 of your W-4. This is everything that we've talked about thus far. The line that gives you the control. Okay, so let me summarize this and put together everything that we talked about thus far and put it into this one easy example. I'm been using the example that I've been using throughout this whole series. However, this time somebody just insisted that I put a picture with this example. So everybody say hello to Kim. Kim is single. She makes $60,000 a year and she gets paid bi-weekly. Remember, Kim's goal at the end of the tax return is for her not to owe nor for her to get a refund. She wants that perfect return with the end result of zero. Well, using all the information that we've learned how to do thus far, we were able to determine that her tax liability is $8,225. Her pay frequency, remember she get paid bi-weekly, so she's getting paid 26 times a year. So based on that formula, tax liability divided by pay frequency, we're able to determine that the amount that she's to have withheld from each paycheck is $316.35, which is the amount that we're going to put on line 6 of the W-4. So at the end result, when Kimberly goes in to turn in her W-4 to achieve the desired result of a perfect return, it's going to look like this. All right, guys, so here it is. The conclusion. At this point, you should have a good idea as to how to get to that perfect return. So do me a favor, don't just absorb this information, put it into action now. Tax season just ended, so I know this video is a few months behind, which means that you are a few months behind, but that's okay. Just do the math and make sure that you're on par. Look at your paycheck stubs. See if you add up the paycheck stubs up until this point, are they on track to meet that goal? If not, make some adjustments. And because things change, people get raises, there's commissions, people change jobs and things like that. Make sure you check where you are at least once every 3 months to make sure that nothing is missed, to make sure that, hey, you got this big commission, you're going to need to account for that. Or if you change jobs, you're going to need to account for that. So put a reminder in your calendar to check where you are at least once every 3 months. Okay? And yes, you have homework. Even though we've done everything up to this far and you should be good to go, you still have homework. At this point, it should be obvious what your homework is. And that is put all that you have learned into action. Make sure that you get the W-4, you fill it out, make sure that you're on track. Gather all of your paycheck stubs, take a look at your income, determine what your pay frequency is, and start putting these formulas into play so you can readjust your W-4 and turn a brand new one into your HR or payroll department so you can start being prepared for the next tax season. Hey guys, thank you for watching the video series. I really appreciate you watching all the videos all the way through the end. And don't worry, if you need help, please feel free to reach out to your tax professional if you need help finding some of the numbers or understanding how to get to your taxable income or things of that nature. And if your tax professional is unavailable, please feel free to reach out to me. You can send me a tweet at AFSO. You can also leave comments below. You can go to the website and fill out the comment form. That sends an email directly to me. Or, just go to Facebook and leave a message. I'll be more than happy to help you in any way that I can. The next few videos are optional videos. I'm probably just going to do some additional case studies, talk about maybe some for the self-employed, because we really didn't get a chance to talk about those guys too much. But for the most part, you have an understanding, and I'm glad I was able to help. Take care, and I'll see you in the next video.